Two people, same city, same age, both 28, both just landed their first real job. Both open a brokerage account on the same Tuesday afternoon, depositing the exact same $300 a month into the same S&P 500 index fund. 30 years later, the first person is sitting at a kitchen table watching their account clear $600,000. The second person checks their account today and has about $41,000. Same starting point, same amount, same investment. A 30-year gap of $559,000. The first person didn't stumble into a crypto windfall. They didn't get an inheritance or land a six-figure salary. The entire difference between these two people comes down to a specific cognitive glitch in how our brains process information. This chart shows what researchers call exponential growth bias. Roughly a third of people perceive compound growth as essentially linear. Your brain looks at a compounding portfolio, draws a straight line, and concludes the math is broken. The reality is, the first 7 years of compound interest look like a flat parking lot. You invest early, you practice patience, and then you watch your account grow by $200 in a month where you contributed $300. It feels like you're going nowhere. Investors typically abandon the process because they are never shown a map of the agonizingly slow journey. They see the destination of compounding wealth, but they lack the blueprint for the years of perceived stagnation required to get there. To fix that blind spot, we use a behavioral framework called the 7-5-3-1 rule. It exists to prevent you from sabotaging the math. The first number in that framework is 7. This visual breaks down the rule of 72, a mathematical formula from 1494, used to estimate how fast an investment will double. Divide 72 by your expected annual return. At a 10% return, that is roughly 7.2 years. 7 is the mathematical minimum horizon before your money doubles even once. This diagram maps rolling return windows in the S&P 500 going back to 1926. Every single 7-year rolling period in the history of the index has produced a positive average annual return. Through world wars, recessions, and global pandemics, 7 years has always been enough time to come out ahead. Committing to 7 years means nothing if a single bad year wipes out your base before compounding can take effect. That brings us to the second number, 5. You need 5 distinct types of assets to endure that required timeline. Broad market index funds do the heavy lifting. Dividend-paying stocks act as a backup system, reinvesting cash to buy more shares. Small cap and international holdings provide performance upgrades, adding percentage points of upside over the decades. Defensive assets, like bonds and treasury bills, exist to ensure you have something in your account that isn't on fire when the primary markets drop 30%. They provide stability while the rest of your portfolio is under pressure. This asset diversification functions as a psychological shock absorber. It is specifically built to keep you in the seat when everyone else is bailing. The reason we need that shock absorber is because the human brain is highly fragile during market volatility. There are 3 predictable emotional phases that routinely derail the exponential curve. Phase 1 is doubt. This happens in the first 2 years. You look at your balance and realize you could cover your total gains with an overtime shift. Your brain starts calculating what you would have if you just put those contributions toward a new car payment instead. Phase 2 is frustration, arriving around year 4. You have $18,000 in the account, but the balance feels stagnant. This phase is dangerous because it hits right before the exponential curve is mathematically programmed to bend upward. Phase 3 is panic. The market drops 30+%, the way it did in 2008 or March 2020. Your account drops below your initial investment, and logic goes entirely offline. This chart shows a sharp market dip. Financial research firm Dalbar, which tracks investor behavior, found that emotional timing decisions, like selling right at the V-shaped bottom, cause the average investor to severely underperform the market. Selling during a crash permanently transfers your potential gains to whoever was patient enough to buy what you sold. If you can survive those 3 emotional hazards, there is one final lever to pull. The number 1. It stands for 1 annual increase in your contribution amount, a subtle bump of just 5%, once every January. This chart compares a flat monthly contribution to one that scales by 5% annually. A 5% increase on a $300 monthly investment is $15. Skipping one restaurant meal a month, incrementally added to your index fund, compounds into nearly $400,000 of additional wealth over 30 years. Surviving those three emotional traps and automating that single growth lever transforms a fragile portfolio into an uninterruptible wealth machine. To truly understand how this machine operates, we have to zoom out and look at the entire lifespan of a compounding timeline. This chart tracks 40 years of compounding. The first decade of disciplined investing generates a mere 3.6% of your total returns. By contrast, the final decade generates 62% of all gains. The overwhelming majority of wealth arrives at the very end. This mathematical reality explains why Warren Buffett accumulated approximately 99% of his current net worth only after he turned 50. The snowball he started rolling simply hit the steep part of the hill. By age 65, the person who followed the framework has $1.1 million. The person who paused contributions and moved to cash during a market dip has $389,000. That is a $711,000 gap. This $711,000 freedom gap is the difference between retiring on your own terms and making a phone call to your daughter to say you have to keep working for another 3 years. As Charlie Munger famously put it, the first rule of compounding is to never interrupt it unnecessarily. Ultimate financial success relies on the discipline to build an aggressively boring system and the patience to leave it alone. The goal is simply to be too boring to quit.